Nilesh Shah, fantastic to have you back on ET Now. Thank you for joining us. Since all of us are confused, we thought we'll chat with you to get some direction for our viewers and find mystery to the price action. Let me paint the optimistic picture, which is good monsoon, low taxes, SIP flows, and globally oil prices have come down. The bulls would say, wow, this is like the perfect recipe for me. But if I look at the screen, State Bank of India is down 10%. There is massive underperformance which has kicked in autos, and we've retraced 50 to 60% of the recent gains after the tax cut we had. So the screen is telling you that we don't care about what is happening in the real world. So why is there a dichotomy between news and the price action in the market?
There are a couple of reasons. Market is driven by three things: flows, sentiments, and fundamentals. From a flow point of view, domestic institutional investors led by mutual funds are buyers, but most of the others are sellers, whether it's FPIs who have taken 3,000 crore from equity in the month of October, or the government who has to do divestment, or the retail and HNI who have lost a lot of money in small and mid caps, or the traders who lost a lot of money in weekly options, especially on the fateful Friday when market went up 2,000 points. So today, from a flow point of view, bearing domestic mutual funds, everyone else is a seller. From a sentiment point of view, clearly there are various things which have kept sentiment on the muted side, whether it's continuity of LPCJ despite STT being leveled, whether it's FPI surcharge, which now fortunately has been resolved, but it has left a bad taste. It's also driven by MSCI emerging market indices changes, where India's weightage will go down by a percentage point over next 1 year, and sentiments try to take things into the future. The most important thing is the fundamental. If fundamentals are good, flows and sentiments will change. In the Monetary Policy Committee, RBI gave a shocking data. The fund flows to the commercial sector of India is down 88% in April to mid-September. From about 700,000 crore, it has come down to 90,000 crore. In no part of the world, growth has happened without money. If fund flows have come down by 88%, how will the growth be sustained? It's an amazing thing that we are still growing at 5%. So as Manish Chokhani mentioned in his tweet, there are many positives in terms of low oil prices, low commodity prices, lower interest rates compared to the past, lower corporate tax rates compared to the past, good monsoon, cleaning up of NPAs in banks as well as NBFCs. But all these things has not resulted into better liquidity in the hands of borrowers. If corporate credit flow has come down by 88%, there is no way growth can be sustained. And this is what market is trying to decipher. Where are the fundamentals? Are we improving? Are we deteriorating? Are we stagnating? And there is enough confusion on both sides. On one side, 5 rupee biscuit packs are not sold. On the other side, smartphones are being sold like crazy. On one side, FMCG companies are going to give the most muted quarter in last 15-20 years. On the other side, Khadi and Village Industries Commission gross sales by 15,000 crore last year. On one side, auto sales have dropped off across the board. But on the other side, Seltos, Hector, Harrier, they are able to record record-breaking growth. So there is a fair amount of confusion today in terms of data, and which is where market is a bit confused. They are waiting for some more clarity to emerge, especially in terms of corporate credit flow, which can sustain growth.
If I just look at the screen here, and I'm just taking a leaf from what you answered, pardon me if I'm sounding repetitive, but it is important for us to clarify this. Let's look at the screen. The prices in Yes Bank, the selling in SBI, the intensity of meltdown in, let's say, in India Bulls, they are reminiscent of the kind of price action we saw in 2008 and 2009. 10% these stocks are falling on a daily basis. The problem is nowhere close to that. And even in 2009, after the fall, when you bought into stocks, you hit a jackpot. So is there reason to believe that tomorrow may not be a great day, end of the October may not be a good time when markets will stabilize, but 3 months from now, 6 months from now, for those who get greedy now, and if they buy good stocks, they would be rewarded disproportionately? Are we in that kind of a linear environment that if you buy now, gods will be on your side to help you make money?
As a fund manager, we are likely to be more optimistic, and keeping that optimistic head, I do believe this is a great opportunity to buy into the market. We have some amount of growth slowdown because of right reasons. NPA cleanup, growth is bound to slow down. Fiscal deficit, prudence, growth is bound to slow down. Inflation control, growth is bound to slow down. Subsidy payouts, leakages being plugged, growth is bound to slow down. RERA kind of cleanup in real estate sector, growth is bound to slow down. So there are right reasons for which growth has slowed down, from fiscal prudence to inflation control to RERA cleanup to subsidy leakages being plugged. Now all these things will result into better growth in the days to come. Second, steps taken right now to reverse growth slowdown will have positive impact in the days to come. Liquidity was negative from 2012 to 2019, but May 19 onwards, RBI has flushed the system. Interest rates are being cut. They have been cut by 135 basis points. They are being cut at a lower pace than the estimate of GDP growth. But eventually, this rate cuts and the continuity further will result into better growth. The transmission is choked today. Credit flow is down 88%. But hopefully, the corrective actions will be taken by way of capitalization of PSU banks and NBFCs and taking out of toxic assets from the banking system. So there is a foundation being laid for better growth, and it will be aided further by better monsoon, lower oil prices, lower commodity prices. More importantly, government has bitten the bullet and showed their path of commitment to reforms by way of one, strategic divestment of BPCL, second, cutting down tax rates to comparable levels with the peer group. The combination of all this will result into better growth, whether it's 3 months down the line, 2 years down the line, that time will tell. Our feeling is that it's not a V-shaped recovery, it's a U-shaped recovery, calibrated, gradual, grinding, but recovery is certain. The good part is that market is discounting negatives far more than actually it is, and which is where you are seeing super large caps trading at very high valuations, large caps trading around their historical valuation, mid cap trading below their historical valuation, and small caps trading way below their historical valuation. We think this is the time to buy small and mid caps on a gradual basis, keeping in pace with the government's reform announcements and recovery in economy. But today, when market has discounted negatives far more than it is actual, today when market is not willing to look at positives, the valuations are in your favor. And if you can accumulate quality stocks at reasonable valuations over the next 6 months, I think you will see better days ahead.
What if we don't see better days ahead? What will cause that?
The world has seen two crises in last 20 years, 2008 subprime crisis in US, 2013 European crisis. And in both the categories, the prescription given by the experts of the Western world was the same. You cut nominal interest rates to zero, you bring real interest rates negative, you open the purse of the government on the fiscal side, you take out toxic assets from the banking system, you capitalize your banking systems so that the faith in the financial system continues. Where possible, you devalue your currency to gain export push. These are all the standard stuffs which people have done. Now, in our case, our growth is still 5%. It's not negative 5%. So we know how Western worlds have come out of their trouble in 2008 as well as 2013. There's no rocket science behind it. It is economics 101. So my feeling is that if things deteriorate further, there will be more actions taken. Fortunately for India, for every problem there is a solution. Only thing, we need to play out that solution. For example, and this is one of my favorite topic and I have raised it many times, India is bleeding its savings to offshore. In last 8 years, between 2011 to 2019, we as Indians have exported $245 billion of our savings in import of gold and precious stones. We are a poor patient who is in an ICU trying to recover his health, but is insisting on giving blood donation. Then it is blaming the doctor that my health has not recovered. Stop giving blood donation, your health will recover. We can't allow our savings to be exported overseas and then complain for lower growth. Those savings needs to be retained in India. Instead of having lofty bars of gold, we need to put that into building a road which is pothole free. So there are problems for India, but there is solution. And my hope and prayer is that we will have the political will, we will have the economic sense to follow a path which leads to higher growth.
Wanted to get in your take as well on some of these PSU stocks. You've seen the overall divestment drive that has kicked in. We saw the kind of phenomenal response as well in the primary markets to IRCTC. Is there potential for re-rating of PSUs?
A lot depends upon whether these PSUs will be allowed to function in a market-friendly manner. Most of these PSUs have incredible talent and incredible assets. What they lack is an environment in which they can flourish. For example, their decision making is constrained. In PSU Bank, every 3 years you are transferred from one department to another. In most private sector banks which are far more successful, people build specialization. Now, if you transfer someone from rural department to treasury and treasury department to rural, how do you build specialization? The second thing is compensation philosophy. The average pay of PSU employee is higher than average pay of a private sector employee. But the average pay of top PSU employees is significantly lower than average pay of top private sector employee. Now, how are you going to attract talent if you are not going to pay them market level? The third thing is related to decision making. Many a times PSU's decisions are not driven by shareholder interest alone. They have to take into account employees, they have to take into account social consideration, they have to take into account regional consideration. All these multiple objectives on them results into underperformance. So by and large, we have stayed away from public sector undertakings despite their incredible valuation, despite their incredible assets, and despite their incredible talent pool. If there is a strategic divestment, then certainly there will be re-rating of these PSUs. A case in point is Hindustan Zinc, which before divestment was making 100,000 tons of zinc. Today it makes 1.5 million tons of zinc. It has grown 15 times in last 18 odd years. That's the potential of PSUs. Moment there is a strategic divestment, I'm sure PSUs will get re-rated.
That's the view coming in on some of the PSUs. What about the earnings season then? What should we brace ourselves for from individual sectors? What kind of commentary would you want to hear from the IT pack? Is it going to be very specific in terms of the kind of sectors that did well in Q1 are likely to continue to do the same way in terms of a follow-through? Where are we likely to see earnings surprises and disappointments, Nilesh?
I think by and large, September 19 quarterly results earnings will be below market expectations. We have seen data for July, August, as well as September getting impacted by floods across the country. It's also impacted by some of the slowdown, which was accentuated from June onwards. So by and large, across the sectors, we will see some sort of disappointment in terms of what market is expecting. However, what will be critical is how do they foresee future? Our feeling is that September 19 GDP growth will be the bottom, and from there onwards, December 19 will be better than September 19, March 20 will be better than December 19. The latest monetary policy, which has revised growth downwards from 6.9% to 6.1%, also is indicating similar pattern. they believe even September 19 will be better than June 19, and thereafter December will be better than September, and so on and so forth. Our feeling is that September could be a little lower than June, but that's where the economic growth will bottom out, and all the steps taken by the RBI and the government will start getting reflected into December 19 quarters and then March 20 quarters.
Nilesh, a year from now or 2 years from now, let's get realistic. When do you think the effect of low interest rates, low oil prices, and the base effect would kick in?
These are all the foundation, Nikunj. What we also need is change in the mindset. There are business families who are today not willing to invest, not because they are not able to get the credit, not because they are not having access to low interest rate funds, but also they believe doing business has become tough. There is uncertainty on the economic future in terms of demand and so on and so forth. So we need to change the sentiments before the fundamentals change. The tax cut announcement is one way to change the sentiment. The cut in the interest rates, provision of liquidity is another way to change the sentiments. But certainly, entrepreneurs today are not looking to start making investments, and which is where September 19 quarterly commentary will become critical. As I mentioned earlier, we expect this to be a U-shaped recovery rather than V-shaped recovery. All the foundation which has been laid by way of lower interest rates, better liquidity, lower tax rates, high monsoon, cleanup in the banking system, low commodity prices, all these things will come together, but in a calibrated and gradual manner.
Right. Okay, Nilesh, great to have you on the show. Thank you so much for taking the time out, sharing the same optimism as Manish Chakhani. That really was the key takeaway when Manish said that, we're going to remember 2019 as the base for a major economic expansion and bull market.